there are a lot of people out there who feel like the Federal Reserve has stolen their opportunity. And what do you tell those people in terms of the distressed opportunities that are there right now?
The Fed has flooded these markets with liquidity, right? So yes, they have rebounded from the March lows. But I think what we would tell people is very simply, look at the high yield default rate. The high yield default rate for 2020 is going to be about 10%. 10% is the highest default rate over the last 10 years. Over the last 10 years, it's been 2, 3, 3.5%, right? So right there, that tells you it's one of the biggest distressed opportunities in the last 10, 12 years.
So it's also very messy out there. We're seeing a lot of creditor disputes as we're seeing a lot of these firms start to restructure. How bad is it getting?
This is new. All the credit documents, with the way they have been set up in the last 10 years, allow private equity funds a lot of room to maneuver. And the result of that is one set of creditors trying to get ahead of the others. By the way, when stuff defaults, everybody's equal. The music stops, nobody's getting ahead of anybody else. But before the music stops, you have this kind of games being played, but these kind of games, it's all temporary games, because in the end, with defaulted deals, the music is going to stop.
Victor, is the music going to stop here in Europe as well? Because I'm interested in the perspective of the Federal Reserve has been there in the US, awash with liquidity, but so too the ECB has been pumping in unison with EU governments. How much are you seeing opportunities to invest in Europe vis-a-vis the US?
In the US, Caroline, we are really good with creative destruction, right? We take our losses, the banks, the asset managers sell, we restructure, we move on. So, look, I've been through 6 of these crises over the last 30 years. The first year or so is always more US heavy. Europe came into this crisis, as you well know, the banking system still wasn't cleaned out. Germany and Italy were still flirting with a recession, even before COVID. So now comes a GDP decline of 7, 8%, double the US of 4%, right? I think our point of view, the European crisis is here. It takes a little longer for the European banks to clean up. So just expect that it's not that busy for us in Europe yet, but over the next 2, 3, 4 years, we expect the Europe cleanup to be bigger and last longer than the US.
You talk about default rates being higher than previous cycles. What about the recovery rates, the cents on the dollars from those defaults, higher or lower as well from previous cycles?
It is lower. We do expect the recovery rates to be lower because, look, the private equity investors have more time to maneuver to see if they can ever put their equity back in the money again, right? So as a result, by the time the default actually happens, the recovery rates you would expect are going to be lower than what they would have been if the default had taken place a year or 2 years before.
I'm glad you keep on bringing up the private equity industry because it seems like they've had a pretty complicated relationship with this industry. You've seen the biggest players, Carlyle, Blackstone, feel somewhat hesitant to dive into this distressed market. Yeah. How is the buy side changing?
The buy side is the buy side itself has in distress the GPs, people like us, right? The industry itself has had a really tough time in the last 6, 7 years. And please, we have not, okay? But the industry's had a tough time because there wasn't so much distress around. The economic recovery was strong. As a result of that, some of the largest distressed hedge funds have shut down. They've gone out of business in the last 15 months. The people who raise money in a lockup structure, a private equity format in distress, their performance has been very iffy, really modest, marginal performance over the last 6, 7, 8 years, right? So the buy side itself came into this crash, the COVID crash, really a pale shadow of its former swaggering self of 2009, 2010, right? And I think what you now obviously look, a really good size opportunity has been created. The buy side is expanding once again today, but I think the last 6, 7, 8 years are just instructive how the buy side came into this crash.
Victor, of course, no one wishes distress on any business out there, but what sectors are you looking at in particular? Is it obvious? Is it the travel sector? Is it the airline businesses? Or are there others that are going to be more long-term, structurally disrupted through what we've just been through?
You know, we believe that a lot of the sectors, including some of the ones you mentioned, right, are really, really hard to invest in. So we're being really choosy. We generally find that airlines are such a tough business. You know, we historically have never really tough, almost uninvestable in our view. Retail going through a secular decline, really hard to invest. So I think somebody like us, we are very cognizant of all the things which can go wrong in some of these industries. And as a result, we tend to have a very good focus. We look today at the cleaning which is going on, at the large amount of distressed working through. And for us, old economy businesses, hard asset businesses, industrial businesses, all those kind of businesses, very much the focus, rather than some of these industries which are under change.